Bitcoin, Ethereum, and other cryptocurrencies are revolutionizing how we invest, bank, and use money every day. Watch our beginner's guide to learn more about Bitcoin, see how the system behind it works, and for the baseline information on investing in some of the most well-known cryptocurrencies to date. This is Amelia, your virtual navigator for this educational journey with Coinfall. Before you start investing in cryptocurrencies, it's important to understand how it works. Let's take a look. Crypto is a type of digital currency that is intended to be used over the internet to make digital transactions. Instead of physical coins, crypto coins are packs of digital data that are encoded using a secure communication technique known as cryptography. It is a division of computer science that stores and transmits data in a particular form, so that only those for whom it is intended can read and process it. Cryptography makes it nearly impossible to counterfeit or double-spend cryptocurrencies. Using this method and an online network of computers, the first ever cryptocurrency, Bitcoin, was created. The first ever cryptocurrency has also been the most popular by market capitalization. Bitcoin, known as BTC, was first launched in 2008 as an electronic payment system based on cryptographic proof instead of trust. The pseudonymous Satoshi Nakamoto published a white paper called Bitcoin, a peer-to-peer electronic cash system that explains how it all works. If you'd like to read this yourself, you can visit bitcoin.org to download a copy of the white paper, or find a link in the description below. The title of the white paper captures two key features of cryptocurrency: electronic cash and peer-to-peer. Many attempts have been taken to develop electronic cash, but what makes crypto stand out is its clever use of existing technologies and distributed systems to make it highly secure and efficient. They allow for direct peer-to-peer payments without third-party intermediaries, such as banks or payment processors, making them highly decentralized with no central governing authority to control its value. The white paper also speaks to how crypto transactions are verified using proof instead of trust. Crypto transactions are recorded digitally, in code, on an open, distributed ledger across participants of the digital currency's entire network. This peer-to-peer network of computers, running free open-source software, is called a blockchain. Each cryptocurrency has its own blockchain, which is an ongoing, constantly re-verified record of every single transaction ever made using it. Essentially, it is blocks of data that are then linked together on a chain of previous transactions. Satoshi describes that cryptographic proof comes in the form of transactions that are verified and recorded on a blockchain, using a consensus mechanism called proof of work. This consensus mechanism is used to verify transactions, using an algorithm that provides a mathematical problem to computers that race to solve it. These computing devices are known as crypto miners. They generally require intense computing power and electricity resources to operate. Here's an example of how a crypto transaction is verified using proof of work. User A wants to send crypto to user B, so a new transaction is requested to be verified on the blockchain. The request is then broadcasted to everyone using that cryptocurrency's blockchain network. The participating computing devices, the miners, then race to solve a mathematical puzzle to help verify a group or block of transactions. Once the transactions are valid and approved, they're clustered together into a single block of data and entered into the blockchain ledger. These blocks of data are then chained together on the blockchain, providing a transparent record of transactions that cannot be altered. Finally completing the crypto transaction, user B will now receive crypto from user A. It's worth noting here that the computing devices that solve the mathematical puzzles, the miners, don't necessarily make large profits if they're mining on a small scale, as this type of consensus mechanism requires intense computer power and electricity resources to verify transactions, as I mentioned before. Bitcoin, for example, currently rewards a miner 6.25 BTC per one block of verified transactions. But the overhead costs of being a miner can sometimes cost up to 90% of the total reward. To reduce these overhead costs and plan for a sustainable future, Ethereum, Bitcoin's biggest rival by market capitalization, is already making the move to switching from a proof-of-work to a more sustainable and efficient proof-of-stake mechanism. Instead of miners, it employs a network of validators who contribute their own crypto in exchange of getting a chance to validate the requests for new transactions. This process is known as staking. Once transactions are confirmed and verified, just like the miners, the validators update the blockchain ledger and earn a reward. The number of transactions each person can verify is limited by the amount of cryptocurrency they're willing to stake, or in other words lock up for a period of time, for the chance to participate in the verification process. This type of consensus mechanism, proof of stake, don't require miners to spend unnecessary resources on duplicative processes, like competing to solve the same puzzle. It's a verification method that removes energy-intensive equation solving for crypto transactions. Reducing the amount of power necessary to verify transactions makes it a more efficient consensus mechanism than proof of work. It also allows for faster verification and confirmation times for new transaction requests on the blockchain. For example, the Bitcoin blockchain has an average transaction speed of 10 minutes using proof of work to verify a block of transactions. Compared with the Solana blockchain, another cryptocurrency, which can verify up to 3,000 transactions per second using proof of stake, it's a no-brainer that Ethereum is looking to make this switch. Ethereum is expected to reduce its energy consumption by 99.95% once this migration process is complete, moving from a proof-of-work to a proof-of-stake blockchain. With both types of consensus mechanisms, transactions are verified based on cryptographic proof. Understanding this concept will help you learn how cryptocurrency is different to traditional money, which is known as fiat currency. Fiat is a government-issued currency not backed by a physical commodity such as gold or silver, but rather by the government that issued it. The United States dollar, the British pound sterling, and the euro are examples of modern fiat currencies. These currencies give the central banks greater control over the economy because they can control how much money is printed. If too much is printed, it can lead to hyperinflation as we've seen in the past. The value of a fiat currency is determined by the government, and it's retained through the stability of the nation's government and its economy. Monetary policies are often used by central banks to manage the value of each fiat currency in relation to others. In most cases, making digital transactions using fiat within the traditional banking infrastructure will require an intermediary, like a bank or a payment platform, to facilitate the exchange of funds between two parties. Think about international payments. These transactions rely on a level of trust between the parties involved to ensure that a transaction is completed. However, the value of cryptocurrency, like all goods and services, is determined by supply and demand. It cannot be influenced by monetary policy tools, inflation rates, or economic growth measures. Based on cryptographic proof instead of trust, they allow for direct peer-to-peer payments. The transactions are facilitated using the blockchain without any centralized intermediary involvement, giving users more financial freedom. These are some of the major reasons why crypto is regarded as a highly decentralized currency. Seen as the first alternative to the traditional banking system, decentralized cryptocurrencies are expected to bring equality of opportunity and economic freedom around the world. While fiat currencies are still used by the majority, some believe that cryptocurrencies and the blockchain technology that underpins them may very well revolutionize finance as we know it today. But the theoretical ideal of a decentralized system and its practical implementation has many differences, at least at the current stage of its development. So, the real question is, should you invest in cryptocurrency? You should know that cryptocurrency prices have so far been highly volatile and are still regarded as a speculative investment by some. Understanding the benefits and risks can help you make more informed decisions on your investments as a first-time retail investor. Here are some benefits to consider. It cannot be denied that the number of people who hold Bitcoin and other digital currencies is growing, with millions already investing around the world. Cryptography eliminates the possibility of a single point of failure, like a sizable monetary institution setting off a cascade of financial crises around the world. Centralized banks and monetary institutions aren't necessary to enforce trust and solve transaction disputes. This means crypto users can enjoy much lower fees and faster confirmation times for digital transactions. The value of cryptocurrency is determined by supply and demand rather than by a centralized government, bank, or monetary policies. Unlike traditional investments such as stocks or bonds, you can easily transfer crypto to anyone else at any given time. Yes, this could easily be billions worth of cryptocurrency that can be transferred within minutes. Users of this currency can transfer the store of value across borders or countries at much lower fees. For example, fiat can be converted to a cryptocurrency like Bitcoin and moved across borders, then withdrawn using the fiat currency of the destination. The sign-up process is quick and only takes a few minutes with any of the popular crypto platforms that you can compare on our website. Purchasing from an established crypto exchange is easy and secure, and can be done using a credit card or bank account. You can buy as little or as much as you want, with reasonably low minimum purchase limits. You can even buy fractional coins. For example, you can buy $50 worth of Bitcoin or Ethereum, whatever the price may be for a full coin. Investments can generate profits, with crypto markets skyrocketing and reaching $2 trillion at one point. However, there are also significant risks that must be considered before you invest. For one, cryptocurrencies have a reputation for being a popular tool for criminal activities and illicit purchases. They're used by hackers for ransomware activities, with an increasing number of incidents each year. The blockchains are in fact highly secure. However, the crypto exchanges and wallet provider platforms can be hacked. Millions of hard-earned money have previously been stolen from users, resulting in devastating losses. Although transactions are made anonymously, they are also pseudonymous. They leave a digital trail that agencies usually affiliated with the government can track down. Technologies could later be developed to identify crypto wallets to a person. Cryptocurrencies are decentralized in theory, with an even distribution of wealth between the many participants on a blockchain, but it is not the case just yet. Ownership can be highly concentrated, with some investors regarded as crypto whales for owning a large portion of the market supply of a coin. Mining can too be highly concentrated, with some industrialized size mining operations existing in some regions. And on the sustainable front, cryptocurrencies that use proof of work uses up considerable amounts of energy resources to verify transactions. Studies estimate that Bitcoin mining uses more power globally per year than most countries, including the Philippines and Venezuela. And the biggest risk of them all, cryptocurrency prices have so far been highly volatile. You may end up losing all your money as a result. Cryptocurrencies at the moment are used for a wide range of activities online, like shopping, logistics and supply chain management, streaming services, sale and purchase of digital artwork, and more. The list of things you can do will for sure grow with time. The global adoption of digital currencies and the advancement of blockchain technology will likely impact the day-to-day life of many people, regardless of their decision to invest in crypto. If you do decide to buy cryptocurrency, such as Bitcoin, Ethereum, Solana, and others, you'll first need to compare and choose an online exchange or broker that deals in cryptocurrencies. Both are essentially online platforms that connects a new user, or connects for the user with a blockchain. Let's have a look at the two options. A cryptocurrency exchange is an online platform where buyers and sellers can interact digitally to trade cryptocurrencies. Some popular exchanges include Coinbase, Crypto.com, FTX, and Binance. While they all serve the same purpose, each has set different fees and limits with varying interest rates, DeFi services, and features. Some even offer free crypto or cashback on trading fees to new users when you sign up. A cryptocurrency broker is an online platform that interacts with an exchange for you. Users can purchase cryptocurrency directly from the broker, often using a more easy-to-use interface. Some popular brokers include Robinhood, SoFi, and Easy Crypto AI. They all serve the same purpose, each with different fees, limits, and varying rates on cryptocurrencies, as well. While a crypto broker may seem like the more convenient and beginner-friendly method, their rates may not necessarily align with the best possible market price for when you purchase or sell a particular cryptocurrency. Brokers often charge a higher fee, and in some cases are known to restrict the movement of user funds out of the platform. As crypto exchanges now offer similar user-friendly purchase options to uncomplicate the experience for beginners, we believe this is the more secure and affordable method to purchase crypto as a new investor. This also gives you an opportunity to learn the standard trading interface of the exchange, and by doing so, find out how to pay lower fees for your next crypto purchase. You can easily learn and compare the fees, new user bonuses, and other important information about popular crypto exchanges with Coinfall. You can even earn some free crypto in the process if you decide to sign up with an exchange like Crypto.com or Coinbase through our website. Otherwise, you can use the referral codes in the description below. Finally, let's take a look at how to securely store your crypto once you've purchased it. When you purchase crypto via an exchange, your funds will be allocated to your exchange crypto wallet, sometimes known as your spot trading account. It is essentially a place to keep your crypto holdings secure within the exchange. The more prominent exchanges are typically insured against crime and have other security measures in place to prevent cyber attacks and theft, which is reassuring. But if you don't plan on trading or staking your crypto on the exchange, you can move your funds to a crypto wallet for added security. There are two types: hot and cold crypto wallets. Hot wallets, also known as DeFi wallets, are stored online and are accessible via digital devices such as phones, computers, or tablets that are connected to the internet. With these wallets, users can interact with smart contracts on the blockchain, such as NFTs or DeFi apps, or an in-wallet browser that lets you surf the web. Cold wallets, or hardware wallets, take the form of external devices like a USB drive or a hard drive. They can never be connected to the internet, and are fully protected from unauthorized access, cyber hacks, and every other vulnerability that comes with being online. Ellipel and Trezor are some reputable hardware wallet companies that we think are cost-effective. You can easily compare these, accessories, and more crypto products by visiting our website. With both wallets, hot or cold, it is important that you store your private keys in the safest way available to you. If you lose the secure code associated with your wallet, you will lose all your crypto funds too. We've covered everything from what cryptocurrency is, how transactions are verified using proof of work or proof of stake, to the risks and benefits of investing in cryptocurrencies. As I previously said, crypto prices have so far been highly volatile and are still regarded as a speculative investment by most people. Continuing to do your own research and seeking advice from a professional financial advisor will ensure you're making investment decisions that you're comfortable to make. This video is not financial advice, and is for educational purposes only. At Coinfall, we aim to bring cryptocurrency to every conversation. Our mission is to raise the awareness of cryptocurrencies globally. To learn more about blockchains and to compare popular crypto exchanges, hardware wallets, and more crypto products, you can visit our website. If you find this guide helpful, don't forget to subscribe below and follow us on our social media for more content. This is Amelia, your virtual crypto navigator. Thanks for watching.